Welcome to Part 3 of the Cost of Capital, the Size Premium and the Firm-Specific Risk Premium, presented by Dr. Stan Feldman.
Now that we've discussed the size of the equity risk premium, let's move on to the other two components that make up the cost of capital. One is the size premium, and the other is the firm-specific risk premium. Let me discuss these in order. First, just spend a few minutes talking about size premium, and then we'll move on to firm-specific risk premium. But let's keep in mind the following, that the cost of capital now is made up of the addition or the sum of the risk-free rate, the market risk premium or the equity risk premium, plus the size premium, plus the firm-specific risk premium. So now, let's consider the size premium. In order to be clear about what we mean by this, take two firms, both trading in the marketplace, which means they're public. They're identical in every respect except size, in every respect. The rate of return on that smaller firm, even though it faces the same set of what I'll call market risks that the larger firm does, the market will require a higher rate of return on it. And the reason that's the case is because the smaller firm has a smaller resource base to deal with unexpected events. So think of it as a cushion, if you will. It has less of a cushion. The larger firm, on the other hand, has far more of a cushion. And therefore, the market discounts the smaller firm while it doesn't apply a discount to the larger firm. So smaller firms are generally more risky because they don't have they have a small resource base relative to larger firm counterparts. Now, the size of this premium, again, varies. Of course, varies by size. So the largest companies, for example, that trade in the stock market have a size premium that's essentially zero. And the smaller firms, let's say firms that have market capitalizations below $100 million, their premium, their size premium can be as high as 6, 7, or even 8%. So the size makes a difference here in terms of the cost of capital. Namely, the smaller the firm, the higher the cost of capital, all else equal. Now, this size premium, again, if you're looking at a public company that, and for whatever reason you're going through an exercise of developing the cost of capital for a public company and it's large, I think what you'll find is that there's the firm, the size premium for those companies are going to be small. And in some cases, if they're large enough, essentially zero. If you're dealing with a private firm that's also very large, that has a very large footprint, and while it's true we don't know exactly what its capitalization rate happens to be, but if it's got a very large footprint, it just happens to be private, that size premium is likely also to be very, very small. Alternatively, when you're valuing a smaller firm, let's say a firm $10 million in revenue, has a before-tax profit of, let's say, $1 million, that firm is going to have a very high size premium when one would calculate its cost of capital. Now, in the exhibit before you, we show what the capitalization or what the premiums look like by capitalization. And you can see from the data that when the capitalization is very high, size premium is virtually non-existent, and when their capitalization is very low, the size premium is quite significant. Now I'd like to move on to the firm-specific risk premium. Now, there, the firm-specific risk premium is something that is difficult to obtain from market data. In fact, it's probably not quite impossible, but and the reason is that the firm-specific risk premium has to do with characteristics that are unique to the firm in question. That is, these are characteristics that it doesn't share with other firms, that is very unique to the firm, and this could be again, it could be a technology, it could be the leader of the company. These are things that are unique to the firm, and therefore offer or present a higher risk profile than a firm that does not have these characteristics. There's a great deal of research in the financial community or in the investment community, academic research, that talks about firm-specific risk. But when they talk about it, they really don't separate out the various components, namely size as an example. And so their notion of firm-specific is really not the notion we're using here. We're using the notion of firm-specific as a unique set of risks that companies face. Now, as a theoretical matter, all firms have firm-specific risk. So the issue is whether these risks are priced in the marketplace. And if you're a public company and you have identified firm-specific risks, the likelihood is those risks are not going to be priced in the market. And the reason is that the investors that are investing in these kinds of public companies are generally very, very well diversified. So when they invest in a company that has these unique risks, the fact that they're diversified means that the risk, essentially, these unique risks, are diversified away. And if these risks are diversified away, investors are not going to be rewarded for taking them. So in the world that we live in, namely the private firm valuation world, these firms also have unique firm-specific risks, but the buyers of these firms, the investors in these companies, tend not to be diversified, which means that the risk, namely firm-specific, has to be priced separately because the buyers or the investors are not diversified. In fact, they're the opposite of diversified. If I looked at owners of private businesses or individuals that would buy private businesses, the research indicates that the bulk of these individuals have their total wealth, or a large percentage, I should say, of their total wealth, invested in this private firm. So they are not diversified. And the buyers, for example, of these private firms, they're also not diversified. So let's, for example, consider an institutional buyer, a private equity firm, for an example. Well, that private equity firm who's buying or investing in a company, they generally are not diversified. Now, when I say diversified, that means they're holding companies across, a whole slew of industries. And the answer is most private equity firms specialize in certain segments. So they're not really diversified. And because they're not diversified, among other reasons, when they price a private asset of this sort, they're going to apply a firm-specific premium. Now, what is the size of this firm-specific premium? Again, there's, as far as I'm aware, there's almost no research which suggests what the size of the premium is. There's some work that I've done that appears in my book, Principles of Private Firm Valuation, which suggests that the firm-specific risk is somewhere between 5 and 10%. And it could be more, but the work I've done, which is presented again in my book on private firm, the principles of private firm valuation, suggests that somewhere it's between 5 and 10%. And there's a way to cobble things together to indicate that that would be the range. And then, of course, the question is, when you value a private firm, if it's between 5 and 10%, what do you use? 5%, 10%? And in order to do this, there's some subjectivity in this. This is not a very well researched area, nor do we or anybody else have what I'll call a complete handle on it. But I think if you look at a private company and you and you look at it and you look at their customer list and you say, well, 90% of the revenue comes from 3 customers. That seems to me to be, point number one, that firm-specific risk is pretty high for this company. If they have a key person that, for example, or groups of people that are key to the success of the company that are not easily replaced, almost by definition, and those people were lost for some reason, that would create a tremendous risk. So they have a small resource base. It's hard to replace these key people if they either get ill, they pass away, they get into some accident, and they can't work for an extended period of time. So those are 2 factors that are critical. Somewhat less critical, I would say, would be whether the private firm has audited financial statements or reviewed financial statements. For many private firms, they have reviewed, not audited statements, because audits actually cost some money, and for private firms that don't have a large number of investors, audited financial statements are probably not required. But then again, since the financials there are not audited, there's some risk associated with whether the financial condition of the firm, as you consider it, is reflected in the financial statements that you're looking at. So I would say that the following: if you have key personnel, a narrow, there's only a few customers generating most of the revenue. There's not audited financial statements. That those 3 factors alone would probably account for somewhere in the neighborhood of 3 to 5% incremental return you would require because of the unique characteristics of the firm.
To continue this presentation, please see Part 4 of this video series, Putting the Components of the Equity Cost of Capital Together.